Vikram, it certainly is going to be something that's possibly going to happen, just once a lifetime, isn't it?
Well, what happened yesterday, of course, as you know, is a technical issue. Yeah?
Right.
I mean, it was a technicality related to the futures contract, the May futures contract for WTI. And basically, all the traders who were holding on to that derivative paper needed to offload it.
Right.
And they couldn't find anyone to roll it over because of the shortage or the constraint on storage.
Right.
So rather than take physical delivery of the product in May, they just bid low the price, desperate to get rid of that paper. And as you know, I mean, normally these sort of contracts get rolled over pretty easily because the differential between, let's say, the May futures and the June futures is not that great. But this time around, June futures was trading at $20 a barrel, and the May future crashed to minus 37. So the differential was such that no one was actually able to roll it over. But this technicality reflects a fundamental reality of the market. And the reality is that it's a hugely oversupplied market.
And correct me, if I'm going wrong here, but the understanding is that there are certain type of oil producers who are producing at around $10 a barrel. Obviously, there is shale at the one extreme, which is doing around $30 a barrel. And then there are some who are producing at less than $5 a barrel.
You're absolutely right. Some of the fields, the giant fields that have been producing for the last God knows how many years, you can produce at cents a barrel, not, even a barrel. But I think one has to go one step beyond the marginal cost of production and ask what is the budgetary requirements of the oil producers. And you're going to take a slightly more macro view, if I may. If you'd ask the question, what is the oil price that oil producers need to break even to balance their budget?
Right.
You'd be amazed. Saudi Arabia needs a price of $82 a barrel. And the most robust of the oil producers are in fact Qatar, which requires a price of around $40 a barrel, and Algeria at the other end is about over $100 a barrel. So at twice, the oil company, Aramco in Saudi Arabia, might still be generating a profit, and on a standalone basis, its balance sheet is not going to go under. Okay, but since Saudi Aramco contributes 80% of the revenues to the Saudi exchequer, the fact is that Saudi Arabia will very quickly have to draw down from its sovereign reserves if it wants to meet its social and economic commitments. And that's the big issue, I think, that everyone has to ask at one level. At another level, at the industry level, the oil companies, can be broken into two categories, broadly speaking. You have the NOCs, the national oil companies, and then the private companies. And if you were to rank order the oil companies by size and indeed profitability, you'd find that probably of the first 20, of the top 20, 16 are NOCs, okay, right. National oil companies.
Right.
And there are then the four like Exxon and Shell and Chevron and maybe Total. The rest have dropped off that list.
Okay.
So the point is that the rest of the industry is going to be struggling somewhat. Occidental, for example, its share price is now below its book value. That's the unique, or you might say the structural change that's taken place, where you have an entire industry facing an existential crisis, and one that will not be resolved if the price of oil just goes from $24, $25 the Brent today to even 40. You know, this is a big issue that needs to be confronted, and that I think is the reason for saying you might well have sounded the death knell of the oil industry.
In the oil space, am I wrong in my understanding that nobody's producing less because of the fear that if they do agree, anybody who agrees to produce less of this commodity will be forced to not produce at all, or will never be able to go back to the original production values that the original quantum of production that they were doing?
It's a good question. I mean, the industry is a cyclical industry, as you know. So when prices fall, demand increases, that then triggers an increase in supplies, and that leads to an eventual decline in price. So if you take a 100-year view over long cycles, you'll see it's really shown over a long period. You'll see that it's been a cyclical trend. So to that extent, 101 plays out in the oil industry. But that shouldn't really, that's not where the story ends. The fundamentals of the oil industry are not just determined by demand and supply. They're also determined by geopolitics. They're also determined by the paper trader. Yesterday was all about paper trading. They're also determined to some extent by the exchange rate. So it's a bit, complicated to say that if the demand falls, or supply will fall, and then hopefully the whole thing will reverse. What's happening now, though, and I may not be answering your question directly, but what's happening now has fallen by such an extraordinary level. I mean, it's this quarter. Some analysts say that it will fall by 30 million barrels a day, which is the entire production of OPEC. The entire production of OPEC is 30 million barrels. One third of global demand has been wiped out. 100 million barrels a day is the average production. Average demand. It was about 102 or 103 last year, and we are seeing a demand fall of 30 million this quarter. Now, against that kind of a demand destruction, a 10 million barrel a day supply cut, which is what Saudi and Russia have agreed to, or the OPEC countries have agreed, is not making a difference. Okay, so that's point number one. Okay. Point number two is that if you do reduce supplies, some fields, some reservoirs could get permanently damaged. Okay.
Are we going to see a major reduction in our annual oil bill, you think, or at least in our oil expenditure for this month?
Oh yeah, I haven't done the numbers, but there will definitely be a significant reduction. But on a per unit basis, obviously, because the price is fallen. But our demand is fallen as well. Yeah. So it's not that in absolute terms we're going to see. We may not see our import bill may come down appreciably, but the impact on the economy won't be proportionately as positive, because our whole economy is in slump.
Yeah.
The big question, and this is the question that I raised in my article, is be prepared for what are you going to do when the economy starts to pick up again? We will still have to go out and import. We don't have 90% of our crude comes from outside India.
What do you think should the government do? Use this any weakness in the oil prices to keep getting more taxes, or considering that there is not much demand, maybe use low prices to maybe boost demand and hope that the economy gets back sooner?
I would do the latter. I would actually
pass on the.
I would look to reducing prices,
right.
And I'm not saying that initially that will boost demand, because that depends very much on economic surgence. But I would not. I think it would be also politically foolish, frankly, for the government to continue to charge all of us the same price when the world has collapsed, I mean, when the price of oil has collapsed dramatically, not just, it's not a $10 collapse, it's 40% collapse.
Is the whole cause of renewable energy, especially in India, is that cause now just, is it a hopeless cause with, at these prices of oil?
It's not a hopeless cause because, I mean, it must not be a hopeless cause. So let's hope that no one asks, no one in government says that, okay? Because it's going to be complicated by the price of oil, of course, but more than that, the supply chain issues. Okay?
Right.
China's supply chain is broken. So that's back to my earlier point, Anant, that we will have to take a slightly longer term view and of all of these questions. Now, if you take a short term view, you're going to say, okay, forget about it, renewables. But you will wake up 2 years, 5 years from now and live, you'll find yourself living in a hellhole once again. There's no getting away from it.